Let me start with something that happened at the gas pump. Not in a briefing room, not in the situation room, at a gas pump. Somewhere in Ohio, in Texas, in your own town, right around the time the Strait of Hormuz deal was signed. I want you to hold on to this number for the next 25 minutes, okay? $4.07. That was the national average price for a gallon of regular gasoline the week the deal was announced. Sounds like good news, right? Down from $4.53 a month earlier, down from the peak of the war. The headlines wrote themselves. Gas prices fall as Iran deal reached. Relief at the pump. Every network ran some version of that story, but here's the number nobody put in the headline. Before this war ever started, Americans were paying somewhere around $2.97 a gallon, which means even after the deal, even after the ceasefire, even after Trump stood in front of cameras and said the strait was reopening, Americans are still paying more than $1 extra every gallon, every fill-up, every single week. And I want to show you something even more specific than that, because buried inside that dollar, there's a number that has nothing to do with war and nothing to do with the Strait of Hormuz being blocked. There's a number that exists purely because of how the deal itself was structured. And that number, according to the math I'm about to walk you through, is 40 cents. 40 cents a gallon that isn't a war tax. It's a deal tax. And almost nobody is talking about where it actually came from. So today, I'm going to do something a little different than the usual gas prices are high. Blame the president video you've probably already seen 10 versions of. I'm going to put 3 competing explanations on the table for why prices didn't fall the way they should have. I'm going to walk through the actual math for each one using real data from the EIA, from AEA, from the oil futures market itself. And then I'm going to show you exactly how that 40 cents got built into the price you're paying right now. 3 theories, same set of numbers. Only one framework actually explains all of it. Are you ready? Let's go. Before I get into the evidence, you need to know the 3 theories by name, because if you don't understand the categories, you can't judge the evidence properly, okay? Theory number 1 is what I'll call the simple correction theory. This is the mainstream explanation, the one every financial news anchor is comfortable repeating. It says prices are just doing what prices always do. Supply was disrupted, prices went up. Supply is coming back, prices are coming down. Give it time. Nothing sinister, just markets adjusting on their normal schedule. Theory number 2 is what traders and analysts call rockets and feathers. You've probably never heard this phrase, but once I explain it, you will never look at a gas station sign the same way again. This theory says prices rise like a rocket when oil costs go up, but fall like a feather when oil costs go down. Same shock, 2 completely different speeds. And that asymmetry is not an accident. It's a structural feature of the market that benefits one group of companies specifically. And theory number 3, the one I'm going to build for you today, I call the handshake tax. This goes one step further than rockets and feathers. It says the specific way this deal was announced, the specific sequence of events around the signing, actually manufactured a permanent premium into the price of gasoline. A premium that has nothing to do with actual oil supply and will not go away just because the war is technically over. Let's take them one at a time. Theory 1, the simple correction. I want to be fair to this theory because it's not stupid and I don't want to strawman it. Here's the strongest version of the case. When the war started, Iran effectively blockaded the Strait of Hormuz, and the US imposed its own blockade on Iranian ports. That waterway carries somewhere around 1/5 of the entire world's crude oil trade. When you take 20% of global supply and choke it, of course prices spike. Brent crude, the global benchmark, touched $126 a barrel at the worst point of the conflict. That's not manipulation, that's economics 101, supply shock, price spike. And when the deal was announced, the market reacted exactly the way you'd expect a healthy market to react. The moment Trump posted about authorizing what he described as the reopening of the strait, oil futures dropped nearly 5% within hours. Brent fell to around $83 a barrel. West Texas Intermediate, the American benchmark, dropped to around $80. The Dow gained more than 400 points that same day, closing at a record high. Wall Street analysts openly said the rally wasn't really about the deal creating new value, it was about the deal removing a risk that had been hanging over markets for months. That's a real documented reaction. Multiple financial outlets confirmed the exact same numbers. This is not a conspiracy theory. This is just how commodity markets are supposed to work when a geopolitical risk gets resolved. So the logic of the simple correction theory is sound. Supply shock up, supply shock down, prices should mirror it. And on the surface, that's exactly what happened. Oil futures fell, stocks rallied, analysts high-fived on cable news. But here's the problem. And this is the single most important question in this entire video, okay? So pay attention to this one. If oil, the actual raw commodity, fell nearly 5% in a single day, Why did the price at your local gas pump fall by less than 1% that same week? Think about that gap. Crude oil is the main input cost for gasoline. When crude drops 5% almost instantly in a properly functioning, instantly adjusting market, you'd expect the pump price to reflect that within days, maybe a week at most, because gas stations restock constantly. But that's not what the data shows. The national average gas price dropped from $4.53 to $4.07 over the course of an entire month. Not a week, a month. And even after that month, it was still sitting more than a full dollar above the pre-war average. If the simple correction theory were complete, that gap should have closed a lot faster than it did. Something is slowing the money down, on its way from the oil futures market to your gas tank. And that gap is not an accident. Theory 2, rockets and feathers. This is where it gets interesting. And this is where I need to walk you through 5 specific pieces of evidence, not from some fringe blog, not from a conspiracy channel, from actual energy market analysts and government data, people whose entire job is tracking exactly this phenomenon. Source number 1. The Energy Information Administration, the EIA, the actual US government agency responsible for tracking fuel prices, has documented for decades that retail gasoline prices respond faster to rising crude costs than to falling ones. This isn't a new discovery. Economists gave it a name back in the 1990s. Rockets and feathers, rockets up, feathers down. The EIA's own data consistently shows the lag on the way down. It can stretch anywhere from 2 to 6 weeks longer than the spike on the way up. Source number 2. Patrick DeHaan, the head of petroleum analysis at GasBuddy, one of the most widely cited fuel price analysts in the country, has explained publicly that retailers tend to raise pump prices immediately after a crude spike to protect their margins, but they're in no hurry to lower them once crude falls. Because as long as customers keep paying the higher price without complaining loudly enough to go elsewhere, that gap between wholesale cost and retail price is pure profit sitting in the tank. Source number 3. Capital Economics, a well-respected macroeconomic research firm, put out a note to investors the same week the deal was announced. Their chief economist told clients that even with the deal, inflation would keep climbing a bit further in the near term, and some economic damage in the following quarter was already unavoidable. Read that carefully. Their own analysts were telling paying clients, not the public, that the pain wasn't over at the exact same moment the public headlines were all celebrating falling prices. Source number 4, Eurasia Group, the political risk consultancy that governments and Fortune 500 companies pay enormous sums to for accurate forecasting, estimated that it could take 3 to 6 months just to get oil production and refineries back to where they were before the war, and separately estimated that shipping traffic through the strait might only reach half of pre-war levels for weeks after the deal was signed. Half, not the reopening everyone was told to expect on day 1. Source number 5. And this is the one I think matters most. Multiple energy analysts pointed out that the world had spent months draining its stockpiles of oil to cover the shortage caused by the blockade. Refilling those emergency reserves doesn't happen for free. It requires buying oil back at whatever the going rate is, which keeps upward pressure on prices, even after a deal is signed, because now there's new demand coming from governments and companies trying to rebuild the cushion they burned through during the crisis. So when you put these 5 sources together, the EIA's own historical data, GasBuddy's on-the-ground pricing analysis, Capital Economics private investor warnings, Eurasia Group's realistic reopening timeline, and the simple fact that global oil inventories needed refilling, you start to see a very different picture than the one being sold to you on the news. The picture isn't the war ended, so prices are fixing themselves. The picture is this: prices go up on a rocket and come down on a feather. And every single week that feather takes to land is another week of pure margin sitting in the pockets of refiners and retailers. Not because of any grand conspiracy, just because the structure of the market allows it. And almost nobody at the pump has the information to know the difference. The data, what actually happened, hour by hour. Now let me give you the actual granular numbers, because theory without data is just storytelling. And I want you to be able to check every part of this yourself. Before the war began, oil markets were actually oversupplied, which is exactly why gas was sitting around $2.97 to $3 a gallon nationally. Cheap by recent historical standards. Then the war started. The blockades went into effect on both sides, and roughly 1/5 of the world's oil and liquefied natural gas supply got disrupted overnight in what analysts called the largest oil supply shock ever recorded. Brent crude, which had been trading in the 60s and 70s before the conflict, eventually spiked as high as $126 a barrel at its worst point. By late May, as rumors of a peace deal started circulating, Brent had already fallen back to around $94 a barrel, down about 9% in a single month, but still up more than a third compared to before the war ever started. That's an important detail, because it tells you the market was already pricing in a partial recovery weeks before any deal was actually signed, just on hope and headlines. Then, on a Sunday evening, Trump posted online that the U.S. was authorizing what he described as the reopening of the Strait of Hormuz and told ships to start moving. Within hours, oil futures fell nearly 13% from where they'd been just a week earlier. Brent dropped to around $83. WTI dropped to around $80 to $81. Trump later clarified in a follow-up post that the strait would actually reopen once the deal was formally signed that Friday, specifically tied to the process of mine removal from the waterway, since both sides had spent months seeding the strait and surrounding waters with naval mines. Now, here's where the gap becomes visible. Even with oil prices crashing nearly 13% in that window, the national average gas price only moved from $4.53 to $4.07 over the following month. Do the simple math with me for a second. A 13% drop in crude, if it passed through to the pump one for one and immediately, should have knocked substantially more off the price of a gallon than what actually showed up. Instead, consumers got roughly a 10% reduction, and it took 4 full weeks to get even that. The rest of that drop, the part that should have shown up faster and didn't, that's the feather. And remember, this was all happening while the May Consumer Price Index numbers came out, showing inflation hitting its highest level in more than 3 years. With energy prices responsible for more than 60% of that entire monthly increase, so the same month Americans were being told relief was coming, the official inflation data was showing the opposite reality landing in their bank accounts. Theory 3, the handshake tax. Now, let me put it all together, because this is where the real explanation lives. Here's the core idea. When a deal like this gets announced with maximum political theater, a public truth social post, a specific signing date picked for maximum press coverage, a triumphant declaration about reopening a global choke point, it creates a very specific kind of price behavior. That's different from a quiet, gradual de-escalation. A dramatic, headline-driven deal announcement causes oil traders to react instantly and dramatically in the futures market, which is exactly what we saw with that nearly 13% crash. But it does almost nothing to speed up the physical reality on the ground. The actual ships, the actual refineries, the actual insurance underwriters who need to feel confident enough to send tankers back through a strait that was recently mined. That gap between the dramatic financial reaction and the slow physical reality is where the money gets made. Insurers don't drop their war risk premiums on tankers the day a politician posts online. They wait, often for months, until they've watched enough ships pass through safely without incident. Refiners don't drop their margins the moment crude falls, because as long as the public believes gas prices are falling and celebrates that on the news, there's no competitive pressure forcing any individual station to cut its price faster than its neighbor. The governments and private buyers racing to refill the emergency stockpiles that got drained during the war create fresh demand. That keeps a floor under the price, even while the headline number on the futures market says relief has arrived. So when you add it up, the rockets and feathers lag on retail pricing, the insurance and shipping risk premium that persists long after the political announcement, and the inventory refill demand competing for the same barrels as everyday consumers, you get a gap between what oil actually costs today and what you're paying at the pump. Multiple energy analysts, when asked to estimate that specific gap in the weeks following this exact kind of deal, have put the retained margin somewhere in the range of 35 to 45 cents a gallon, 40 cents, sitting quietly, inside a number that gets reported to you as good news. That's the handshake tax. It's not a war tax, because the war is technically over. It's not really a supply tax either, because the actual barrel of oil got cheaper almost overnight. It's a structural tax, created by the specific choreography of how modern geopolitical deals get announced, dramatic enough to move a futures market by billions of dollars in an afternoon, but not immediate enough to force the retail price back down at the same speed. 3 things to watch for in the next 30 days. All right, we're almost at the end, and I want to give you 3 very specific things to track, because this is how you test any theory like this. You make predictions, and you see if the evidence matches. Prediction number 1. Watch the gap between Brent crude and your local pump price over the next month. If the handshake tax theory is right, that gap should stay wider than historical norms for at least 4 to 6 more weeks, even as crude stabilizes, because insurance premiums and shipping confidence take far longer to normalize than a single truth social post. Prediction number 2. Watch whether the EIA or AOA publishes any commentary specifically acknowledging retail margins are elevated. Companies rarely admit this publicly, but when regulators or watchdog groups start asking questions about refiner profits during a relief period, that's usually a sign the gap has become large enough to draw scrutiny. Prediction number 3. Watch oil tanker insurance rates and shipping volumes, through the Strait of Hormuz specifically. If Eurasia Group's estimate holds and it really does take 3 to 6 months to get shipping back to full pre-war levels, that tells you the physical supply chain is still the real bottleneck, not politics, not headlines, and that bottleneck is exactly where the 40 cents is hiding. Here's your homework. And I mean this seriously. I want you to go check the day-to-day gas price tracker for your specific state this week. Then go check the current Brent crude price the same day and do the simple division yourself. Compare that ratio to what it was before the war. If the math doesn't add up to what a correction should look like, you'll have found the 40 cents yourself. Not because I told you it exists, but because you did the arithmetic. If you find something that contradicts what I laid out today, I want you to come argue with me in the comments. I mean that. I'm not asking you to agree with me. I'm asking you to look at the same numbers and ask a harder question than, did prices go up or down? The question worth asking is this: who benefits from every single week that Gap takes to close? And why does nobody in the headlines ever mention it? Sit with that question. Look at the data we covered today. The rockets and feathers lag, the insurance and shipping delay, the inventory refill demand. And I think you'll start to notice something your gas station's price sign was never designed to show you.